Welcome to the deep dive. We cut through the noise of corporate reports to give you, well, the essential insights you actually need.
Exactly.
Today we're tackling SASA Polyester Sanaye Ha, specifically their Q3 2025 results, financials, operations, the whole picture.
And it is quite a picture. SASA is a huge name in Turkish industry, right? And they're in the middle of this massive transformation, really trying to become a petrochemical powerhouse.
Yeah, aggressive is the word.
Our goal here is simple. Take these dense reports, the activity report, the financial statements, and, translate them for the individual investor. Because, honestly,
Yeah.
the numbers are telling two very different stories this time.
That's the real challenge, isn't it? You've got this giant company pouring billions into growth, but they're running headfirst into some serious global economic headwinds. It's complex.
Definitely.
So we're here to save you the headache, save you the hours of reading. Let's start at the beginning. Who exactly is SASA? What's the foundation here?
Okay, so SASA is based in Adana, down in Ceyhan. Their core business. It's all polyester. They make polyester fiber, filament yarn, PET resin that's used a lot in packaging, and PET chips.
And they're not just a local player.
Oh, absolutely not. They're dominant. Turkey's biggest polyester producer, for sure. But they're also a leader across Europe, the Middle East, Africa. We're talking about roughly 1.5 million tons per year of polymerization capacity. That's serious scale.
Pretty staggering scale. And they've got subsidiaries set up to handle things.
Right. They've got SASA Düş Ticaret, which obviously handles the export side, and SASA Uluslararası Finansal Yatırım. That's for the financing aspects. Standard stuff for a big company.
Okay.
But the really interesting development, especially this quarter, is the new one, SASA Refinery İş. It was just founded in September 2025.
SASA Refinery. Okay, so that ties into the bigger picture.
Exactly. This is the vehicle for that absolutely enormous U-metallic refinery and petrochemical complex project they're planning. Setting up this specific company, SASA Refinery, it really signals, that management's focus is shifting. It's not just polyester anymore. It's full-on petrochemical integration. That's the long game.
Got it. And who owns SASA? Is it widely held or?
No, it's actually highly concentrated. Erdemolu Holding is the main player. They've got just over 60%, 60.44% to be precise.
Okay.
And then another Erdemolu entity, Erdemolu Global Gayrimenkul, hold another 13.24%. So yeah, the Erdemolu Group has firm control.
Right. What about the board, the governance side? Anything interesting there?
There is, actually. It's a 10-member board.
Yeah.
And what stands out is the female representation. 4 members are women.
4 out of 10.
Yep, 40%. And they're all serving as independent non-executive directors. That's quite positive from a corporate governance perspective, especially in this sector.
That is noteworthy. And this expansion, it must mean more people on the ground?
It does. Staff numbers are up. They hit 4,030 employees by the end of September 2025. That's up from about 3,800 at the end of 2024. Most are based there in Adana, naturally.
Makes sense. And running an operation this size, managing this transformation, it costs money at the top too, right?
Oh, absolutely. The report states the total cost for the board and the executive management team for the first 9 months of 2025 was 59.8 million Turkish lira.
Okay. So we have the structure, the ownership, the people. Let's pivot now to the world they were operating in, because Q3 2025, it wasn't exactly smooth sailing globally, was it? Especially for manufacturing.
No, far from it. The macro environment was, tough. You had this global economic slowdown really taking hold in key markets.
Right.
And consumers, they were getting nervous. High inflation, geopolitical stuff bubbling up, Russia, Ukraine still ongoing. Those tensions between Israel and Iran flaring up. People were starting to save more, cut back on non-essentials. Textiles took a hit.
And that creates pressure from competitors too, I imagine.
Huge pressure. You see, with U.S. buyers trying to diversify away from China, those Far East producers didn't just disappear. They got really aggressive, pushing their products hard into other markets.
Like Turkey.
Exactly like Turkey. So SASA faced intensified competition right on their doorstep, just as overall demand was weakening.
You can really see that demand picture playing out. You mentioned PP resin for food and packaging held up okay.
Yeah, necessities tend to fare better in these environments. Demand there was relatively stable.
But the textile side?
That's where the weakness really bit. Fibers, yarns, the stuff going into clothes and home furnishings. Both global and domestic demand were weak. That consumer caution, that shift to savings, hit them directly.
And we see that reflected right in the production numbers, don't we? Comparing the first 9 months of 25 to 24.
Absolutely. It's stark.
Wow.
Polyester chips production was actually up strongly, 48% increase. That's significant.
Okay, so intermediate product up. But the finished goods?
That's where you see the hit.
Mm-hmm.
Fiber, POI, yarn, Finished products saw big drops. Volumes down anywhere from 12% to 28%. That's a direct consequence of that textile sector slowdown you mentioned.
Yeah.
But, and this is crucial, the scale of operations is still expanding massively because of the new investments coming online. The big one is PTA purified terephthalic acid.
Right, the raw material.
Exactly. They produced almost 590,000 tons of it in the first 9 months of 2025. Last year, zero. Commercial production kicked off in March 2025.
So huge new capacity online. But interestingly, you noted the overall capacity utilization rate actually dipped a bit, from 77% down to 74%.
It did, just slightly, which is maybe surprising given the scale of new operations, but likely reflects that weaker demand for the end products, even as they're making more of their own raw materials now.
It's all set against this backdrop of just incredible investment, isn't it? What was the total figure again?
Since 2015, the cumulative investment is around $4 billion US,
Yeah.
an absolutely massive sum.
$4 billion. And 2025 was really the year a lot of that came to fruition.
It really was. That PTA plant is the absolute centerpiece. We're talking a $1.75 billion investment, capable of producing 1.75 million tons a year.
And the strategic impact is huge.
Enormous. The report emphasizes this. The plant now meets SASA's entire need for PTA.
Whoa.
100% self-sufficiency in a key raw material. That's massive for cost control and supply security.
Wow.
Plus, there's an energy angle. Between waste heat recovery from the PTA process and their solar investments, they're covering about 60% of their own annual electricity needs now. Huge efficiency gains.
That's a major strategic shift. But playing devil's advocate here, launching these huge expensive plants like this PTA facility right into the teeth of a global slowdown. Is there a risk they've built this incredible capacity just as the market's taking a downturn, pouring billions in when demand is soft?
That is the billion-dollar question, isn't it? It's the central strategic gamble. Management is clearly betting on the long-term structural advantages, self-sufficiency, lower cost, modern tech. They're not just managing quarter to quarter.
So they pushed ahead regardless of the macro headwinds.
Absolutely. Remember, it wasn't just the PTA plant. They also brought the MTR chip plant online in April. That's methanol to resin, 330,000 tons a year capacity.
Okay.
And then in September, the big new fiber plant started trial production. That's another 350,000 tons a year capacity.
And that new fiber plant, that's supposed to bring in significant revenue, right?
That's the projection. Around $400 million US in annual revenue once it's fully ramped up. So they are expecting these new assets to contribute significantly to the top line, and soon.
And this is all just groundwork for the even bigger dream, that Umertaluk project.
Exactly, the $25 billion Umertaluk petrochemical project. The goal there is ambitious. 100% import substitution for the products made there. Plans start around 2026. It's a generational bet for the company.
A massive long-term vision. You also mentioned something about sustainability with the new PTA plant.
Yeah, it's an important point they highlight. The plant was designed for environmental efficiency. Apparently uses 75% less wastewater and produces 65% less greenhouse gas emissions compared to older, traditional PTA technologies. They're building for the future, anticipating stricter regulations, aiming for world-class standards.
Okay. So, summing up the operational side, massive investment, finally coming online, achieving huge self-sufficiency goals, building modern, efficient plants, but doing it all while the global market, especially for textiles, is weak.
That's the tension right there.
So the big question then, what does all the investment, the self-sufficiency, the weak market, what does it actually mean for the financial results? Because looking at the numbers, well, folks should probably brace themselves.
Yeah, the short-term financial picture is jarring.
Oh.
Let's start with the top line. Net sales actually dropped quite significantly, down to 38.6 billion Turkish lira in the first 9 months of 2025, compared to 47.4 billion in the same period last year.
Ouch. Almost a 9 billion lira drop in sales. And profitability.
That's where it really hurts. The gross profit margin just collapsed. It went from 20% in 9M 2024 down to only 8% in 9M 2025.
Wow, 20 down to 8.
And EBITDA margin fell too, from 18% down to 14%. So operational profitability took a major hit from the market conditions and likely ramp-up costs too.
And the bottom line, the net result.
This is the headline number that grabbed you. SASA swung from a net profit of 23 billion lira in the first 9 months of 2024
23 billion profit.
to a net loss of 10.1 billion lira in the first 9 months of 2025.
A 10 billion lira loss. That's a massive reversal Over 33 billion lira difference year over year. What on earth drove that? It can't just be the sales drop and margin pressure, surely.
No, not entirely. While operations were weaker, the main culprit, the thing that really blew up the P&L, was the cost of financing all this transformation. Financial expenses. It just exploded.
How much are we talking?
41.7 billion Turkish lira in financial expenses for the first 9 months of 2025.
Wait, 41 billion in just finance costs. How does that compare to last year?
It more than doubled. Last year was 20.8 billion lira. So yeah, a massive increase.
How does a company even absorb nearly 42 billion lira in finance costs? What's behind that staggering number? And is it sustainable?
Well, there are two big drivers here. First, obviously, is the sheer amount of debt they took on to fund that $4 billion investment program. High interest rates globally certainly didn't help.
Right, the debt burden itself.
And second, and this is a really important nuance for understanding Turkish financials right now, is the mandatory application of inflation accounting this year.
Ah, IAS 29. How does that impact the loss?
It has a huge impact, often non-cash. Inflation accounting requires revaluing assets and liabilities. For a company with large non-monetary assets like SASA, this can create massive monetary losses on the income statement, even if the underlying cash generation is okay. It significantly inflates the reported net loss figure you see. It distorts the traditional P&L view.
Okay, so the reported loss is heavily influenced by accounting standards and the huge debt load. This brings us to a critical point. Can they actually service that debt?
That's where we look at the interest coverage ratio. This measures operating earnings, or FEV as it's often called in Turkey, against the interest expenses. And the result here is, frankly, alarming.
How bad is it?
It plummeted. In 9M 2024, it was 1.21, meaning operating earnings just covered interest costs. In 9M 2025, it dropped to 0.51.
0.51. So operating earnings are only covering about half their interest payments.
Exactly. That 0.51 is probably the single most worrying figure in this entire report. It signals real, acute, short-term financial stress. That lack of coverage is a major red flag.
And the market noticed this.
Oh, yeah. You saw it reflected in the credit rating downgrades.
Yeah.
Fitch cut their rating down to CCC. That category basically signifies a high risk of default. JCR of Russia also downgraded them, though to a slightly less severe ATR. Liquidity metrics also weakened. The current ratio fell from 0.47 to 0.37, and leverage went up. Total liabilities to equity increased to 1.15 from 1.06. Equity itself actually declined.
So, massive accounting loss, operating income not covering interest, credit downgrades, worsening liquidity, yet management is steaming ahead with these huge projects. This feels like a paradox.
It absolutely is. And this is where you as an investor really need to understand the nuance, look beyond that scary bottom line net loss.
Okay, explain the paradox.
The paradox is this, that huge net loss is driven heavily by non-cash inflation accounting effects and those massive but largely financing-related expenses. But if you look at the cash actually being generated by the core business operations.
The cash flow statement.
Right, net cash flow from operating activities,
Wow.
that actually increased significantly, went up from 14.4 billion lira in 9M 2024 to 23.0 billion lira in 9M 2025.
So wait, despite the net loss, the actual cash generated from running the business went up substantially.
Precisely. The core operational engine is still throwing off a lot of cash, more cash than last year, in fact. Operationally, things are healthier than the P&L suggests.
So the business itself is fundamentally cash generative, maybe even improving its cash generation thanks to the new plants starting up.
Plausibly, yes.
But the sheer weight and cost of the financing for this massive transformation is crushing the income statement and creating this picture of financial distress.
You've nailed it. Operationally, there's underlying strength and significant cash generation. Financially, the structure is under immense strain due to the high leverage and the cost of that rapid growth. The classic investment phase crunch.
That explains why they didn't pay a dividend for 2024 too, right? Even if TFRS showed profit, the local standard maybe didn't.
Exactly. The report confirms that. Under VUK, the Turkish tax accounting standard used for dividend decisions, they showed a loss. So despite a TFRS profit which got transferred to reserves, no dividend could be paid out.
But they did continue buying back shares.
They did. The share buyback program continued, spending about 356.5 million lira under the current authorization during these 9 months.
Okay, this deep dive really paints a picture of a company walking a tightrope, doesn't it? A real high-wire act.
Absolutely.
On one hand, SASA is building this incredible strategic industrial complex, achieving vertical integration, energy savings. things that could secure their future for decades, a truly transformative vision.
A fortress, as you said.
But on the other hand, the sheer cost and speed of that build-out have plunged them into a serious short-term financial squeeze. Collapsing reported profits, those really worrying debt coverage ratios, credit downgrades.
The entire market is essentially holding its breath now. Everyone's watching to see if the expected revenue boost from those new plants, the PTA self-sufficiency savings, the MPR chips, that $400 million projected from the new fiber plant, if all that will materialize fast enough and strongly enough to pull them out of this financial danger zone.
So the fundamental question for anyone looking at SASA right now is existential.
It kind of is, yes. Will the operational improvements and new revenue streams ramp up quickly enough to fix that debt servicing problem, to get that interest coverage ratio back above 1.0 and climbing? Or will the crushing weight of the short-term financing costs potentially derail the whole grand long-term vision before it fully bears fruit? That's the critical point of tension right now. Operational success versus financial survival.
A truly crucial intersection point for the company and its investors. Thanks for breaking that down so clearly.
My pleasure. It's a fascinating, if challenging, story to follow.
Absolutely. And if this deep dive helped you understand the two conflicting narratives driving SASA right now, please do share it with others who might find it useful. Subscribe for more analysis like this. We'll catch you on the next deep dive.